Good afternoon, everyone. Thank you so much for joining us for today's free webinar, Issuing Equity to Employees, What Founders Need to Know, with Annie Weber from Legal Hero and David Ehrenberg from Early Growth Financial Services. I'm Erica Mausberg, and I'm the Chief Marketing Officer for Early Growth Financial Services, and I'm going to be your moderator today. This presentation is going to run probably about 45 minutes or so. If you have questions as we go along, please feel free to just jump in with them. Don't just raise your hand or feel like you have to wait till later at the Q&A. Just jump in and enter them in the question field. You can also tweet them to us at earlygrowthfs with the hashtag #StartupEquity. And we're going to do our best to answer the questions as they come, or depending on how things are going, we might wait till the Q&A at the end to address them. Also, if we do run out of time, we will follow up via email or Twitter, and we're going to make sure that we get all of your questions answered. We'll be providing contact information at the end, so you'll be able to follow up if you have, questions that are specific to your business that would make more sense to just have a one-on-one to chat about. We're also recording today's session, and we'll be sending out a follow-up email tomorrow that's going to have a link to this recording and to the slide deck, so you'll have these for your reference. And I will say that the slide deck isn't the most exciting one visually, but it's really content-rich, so it really will be a good resource for you in looking back to reflect on some of the main points that we'll be discussing today. So before we jump in, I just want to do a quick introductions here. First, we have Annie Weber, founder and CEO of Legal Hero. Annie started Legal Hero to make getting legal help simple. Most recently, she worked as an attorney in mergers and acquisitions at Ropes & Gray in Boston. She received an AB in government from Harvard College, a JD from Harvard Law School, and an MBA from the Harvard Business School. So clearly an underachiever there, Annie. So good afternoon and welcome to you.
Hello, Erica. Thanks for having me.
Of course. Thank you so much for being here. And we also have today with us David Ehrenberg, and he's the founder and CEO for Early Growth Financial Services. As CEO, David has overseen our incredible growth here, leading to us being ranked number 13 in Silicon Valley Business Journal's Fast Private for 2014. And we even got our first ranking on the Inc. 5000 list in 2014 at 797. Very exciting for us. David's an active speaker within the startup ecosystem, and his insights have been published in Forbes, Inc., VentureBeat, and more. He's a financial expert and startup mentor with a passion for supporting founders and helping businesses to focus on what they do best. So good afternoon and welcome to you, David.
Fantastic. Thank you very much.
Of course. So before we flip the slide and jump in and get going here, Annie, can you first start by saying just a few words about Legal Hero?
Yeah, sure. I mean, you summed it up pretty well, but, Legal Hero, we are all about making law as simple as possible. We know that it can be a scary, intimidating, and expensive area for startups. So we seek to simplify and streamline things by providing vetted and experienced lawyers, always at fixed prices for discrete projects. And we also actually, for those companies that need more consistent help, provide fractional general counsel services on a monthly basis.
Great, thank you. And David, just a few words about Early Growth?
Sure, absolutely. So Early Growth Financial Services is an outsourced finance and accounting organization. It's not a very sexy job, but we work with really sexy clients. And we do 4 things for these clients. We take care of all their transactional accounting, so all the blocking and tackling from an accounting perspective, their general ledger transactions, their accounts payable, their payroll, preparing their financial statements, all the basic things that every business needs. We have CFOs that do the same things that a CFO would do at a much larger company on an outsourced basis, so budgeting, forecasting, planning, fundraising, pricing, working with legal teams, everything that a CFO would do at Apple or Google, just on an outsourced basis. We do taxes. So all the exciting things that fall into the world of taxation, state and federal taxes, R&D tax credits, sales and use taxes, all those fun things. And the last thing that we do is valuations. And we do higher end valuations, but we also spend a lot of time doing 409A valuations. And we'll talk a little bit more about what 409A valuations are and how they impact all of you. Early Growth is located in we're a nationwide firm, but we have offices in 9 cities across the country, and we work with somewhere between 500 to 600 clients.
Awesome. Thanks so much, David. So now we will get to the main show here, and I will let Annie start by doing the lawyerly thing.
Hi, everybody. As the resident lawyer on the phone, I have to say we're going to be talking about, issues that involve law and taxes. And so we have to say, that nothing here is intended to create an attorney-client relationship. It's not specified legal advice for your business. So, this is to give you a general understanding, but please do consult with, a lawyer and your tax consultant for any of these issues. So just, moving on, what we're going to talk about today. So, at a basic level, we want to talk about, why in the world do you issue options? Do you issue stock? Why are we sharing the pie? We're going to talk about what are the ways in which you can share that pie, what types of instruments, equity instruments, are commonly used, options and stock and restricted stock units, etc. Then David's going to talk about 83B elections and the two different types of options which are taxed differently, which are called NSOs and ISOs. And then lastly, we'll be going over some structuring considerations for how you issue equity and talking about 409E valuations as part of that process. So I suspect that because you're on the phone, you sort of already have an idea of why you want to share the pie with employees. But, just to go over it, in the startup context, nothing matters more than attracting and retaining the right people to establish and grow your business. And you really want them laser focused on that growth. You want their incentives to be aligned with your own. So you, by attracting, use this equity to attract talent, to retain that talent, and then to align incentives between the company as well as the employees. So just moving on to the overview.
Also, Annie, can I jump in?
Yeah, of course. Go for it.
I also think that issuing equity, obviously it gives incentives. It obviously aligns expectations and aligns deliverables. But it also makes your employees feel like they're part of the team. And we have found that companies where the employees feel that they're vested, they are so much more committed. They have so much more dedication. And they feel like this is their thing. They're part of it. And there's a lot of great reasons to give out that equity, and it's a very positive experience for those folks. Sorry.
Yeah, I absolutely agree. We see that over and over again with the companies we work with. Just, talking about the overview. So there are, you can issue equity in lots of ways. We're going to focus in on the three most common ways to issue equity for startups. There are three types of equity that you're going to hear mentioned over and over again. The first is stock options, and I know that these get, the terminology gets bandied about a lot, but in case you don't know, stock options represent the right to purchase shares in the future. So by being given a stock option, you don't actually own the shares. You have to buy them in the future at a price that's been decided at the date of the grant. The second common type, especially among co-founders, is restricted stock. And that is actually shares that are granted subject to certain restrictions. That makes them slightly different from the third type of equity grant, which are restricted stock units, because that's actually, you're not getting equity. You're not actually receiving the shares up front. You're receiving units that represent the right to receive shares once the restrictions have been met. And those types of restrictions are pretty common across both restricted stock and what they call RSUs, restricted stock units. There's a universe of equity types. The other two common ones you'll often see, but not very rarely in the early startup context, are stock appreciation rights and phantom stock plans. And basically these are bonus plans. You're not actually receiving shares as part of these. You're receiving the right. You're getting the right to receive cash or stock, based on the increase in value. So it's meant to align incentives. It's most commonly used with bigger companies. Phantom stock plans are similar. They basically mimic a traditional stock plan that might be given out. So you're following the stock price of a company. And you then give out cash to employees or stock based on the value of the shares as they move up and down both stock appreciation rights and phantom stock plans are pretty unusual in the startup context, so we're not going to focus on those today.
Okay, so we already have our first of what I'm imagining is going to be many questions today. First, Pri just wants you to clarify here, if someone purchases options, do they actually own common stock?
So what usually happens in this context is options are given to employees. So the option itself is not purchased. What the option represents a right to purchase the share in the future. So, for example, you might give an employee an option to purchase a share in the future, but the option represents the right to purchase a share of that company in the future for, let's say, 5 cents. Well, in the future, when they can actually exercise that option, the stock might actually be worth 50 cents. So, and you're essentially buying it for only 5 cents. So options aren't purchased, they're given, and they represent the right to purchase a share in the future. Does that clarify things a little bit?
I think so. Just another clarification question. If you could can you just define what you mean by early exercise?
Early exercise. I don't think I said early.
Oh, you didn't. Okay. Sorry. Maybe we misheard. Someone's asking you to clarify. So we can move on then.
In the context of exercising, you're going to exercise. So we're going to go through the details of each of these 3 types in the next slide. I actually think that might help clarify when you can exercise the options, because that is defined by the company as part of its option plan generally.
Okay, cool. Why don't we move on, and then, if there are follow-on questions, we can ask those.
Absolutely. Great. So just, we're going to narrow in on the world of options versus restricted stock versus RSUs. And please keep in mind, restricted stock and RSUs are very, very similar and related to one another. With stock options, so the difference is, as I mentioned before, stock options, when employees are given stock options, they represent the right to purchase shares in the future at a price that's specified on the date of the grant of the option. So an employee will receive an option agreement, and that option agreement will say, let's say the employee is Susie. Susie is going to get 10,000 shares at a strike price of, let's say it's $1. And on today, which is June 30th. And this option expires in 10 years. Well, that means that depending on when the options vest, which we will also go over, at any point in the future when they're vested, Susie can actually buy those shares at $1 a share before the option, at any time before the option expires. When you're thinking about restricted stock, it's really different. You're not actually giving people the right to buy stock. You're giving them the stock outright. Now, you're making that gift essentially subject to certain restrictions, like vesting, which we will cover. But they're not actually going to have to purchase anything in the future. You're actually giving them the stock. Similarly, with restricted stock units, you're giving them the right to receive the shares upon certain restrictions. So the difference there is once you meet the conditions, that is when the share is actually dispersed to you. Versus with restricted stock, you meet the conditions. You sort of already own the stock. You just have a right, non-forfeitable right to it, I should say. So thinking about the value of these 3 different types of equity instruments, stock options, it really depends on, how high that stock, the value of each individual share goes above the exercise price. So, in that example, we issued Susie options at, with an exercise price of $1 a share. Well, if down the line, 5 years down the line, she's still working at the company, and now that stock is worth $5 a share, by exercising her options, she's made $4 a share. If the stock, however, goes down and is worth 50 cents, then those options are worthless because she's not going to pay $1 to get something worth 50 cents. Restricted stock really depends on the value of it, depends on the stock price at vesting. So, the main condition associated with restricted stock is vesting, which we'll go over, but vesting is basically when you actually acquire ownership of it because the restriction has lapsed. And so, if you're receiving it when the stock price is $5, you get the whole $5. If it dips to $3, you get the $3. So it doesn't become worthless just because the stock price goes down a little bit. And the same thing with restricted stock units. Now, in terms of payment, again, there is a payment associated with stock options. You have to pay the exercise price in order to exercise them and receive the shares. There is no payment associated with restricted stock or restricted stock units. People think about voting rights within the company or right to dividends. Well, when you're thinking about stock options, you earn those voting rights and any rights to dividends upon exercise because those are associated with the actual underlying stock, not the option. So once you own the stock, that's when you get those voting rights and dividends. This is where restricted stock and restricted stock units are a little bit different from each other. With restricted stock, you actually do have voting rights even before your stock has vested because you own the stock. You just don't have the full unforfeitable right to it. Restricted stock units, because you're essentially just receiving a unit that represents the right to receive the stock in the future, you don't have voting rights or rights to dividends, but companies will often reward employees with dividend equivalent bonuses in those cases. Now, taxes. David's going to go over this a little bit more a couple slides down, but stock options are basically taxable when you exercise, when you're talking about NSOs, which are non-statutory stock options, and ISOs, and they are taxable at share sale for ISOs, which are incentive stock options. For restricted stock, unless you file an 83B, which David is going to explain, they are taxable at vesting. So it's not on the day that you receive the grant of restricted stock, it's on the day that the conditions expire and you fully own it, unless you file that 83B. And then restricted stock units are taxable at vesting, and an 83B isn't relevant in this case because you don't actually have, again, you're owning the unit that is a right to earn the stock, not the actual stock. So when do you see these, various types of equity instruments used? You're going to see stock options in early stage high growth startups, companies where the valuation is expected to go up because, again, like we talked about before, the value goes down, options become worthless. So people are going to use them when things are, there's a high growth opportunity. Restricted stock you'll see often in co-founder arrangements, and the reason for that is, these people are getting the stock when the value of the company is basically nil, and so, they want to own the actual stock, not an option, and they want to take advantage of that growth of the stock. And yet at the same time, because you see co-founders with varying concerns and varying interests, they want to provide restrictions so that neither co-founder can walk away with a massive chunk of the company. And then restricted stock units, you're going to see more mature companies or later stage startups, especially those with more liquid stock, where employees might actually be able to sell the stock even as the valuation moves up or down slightly. So why are stock options so common? As I said, there's a significant upside. Also, it's important for employees to be able to time their taxation, their tax bills. It's sort of a pain when you owe money at vesting if you have very little cash on your balance sheet to pay it. So it's nice that employees don't have to pay anything until they actually exercise their option. As opposed to restricted stock, co-founders like it because, as David will explain, they can file an 83B and pay very little in taxes, expecting a rise in the valuation. So there's a lower downside risk at that point. And restricted stock units, taxes are due at vesting, but because you've got mature stock there, you can generally sell that stock in order to support any tax payment that's required. So I know that's a lot of information across the 3 different types. If you have any questions, I'm happy to clarify things. But needless to say, if you hear nothing else, hear that restricted stock is really common when co-founders are negotiating. Who's going to get what in terms of stock. Stock options are the most common for startup employees, early stage to mid stage, and then restricted stock units usually come into play later on in the life cycle of the company.
Okay, the next section is on 83Bs, and as Annie talked about in the last slide, if you get restricted stock, you need to pay taxes on those restricted stocks as the stock is vesting. So if you have a vesting schedule and the stock is vesting, if the share price has gone up, you're going to have to pay tax on that increase when the company vests. Now, the way that you can avoid that, the way you can get out of that tax obligation is through an 83B. An 83B allows you to actually purchase the stock, the restricted stock, when you receive it. However, you need to make that purchase within the first 30 days after receipt. The huge advantage of using an 83B is that you're going to avoid that taxation on the future vesting. You're going to basically, well, not basically, you will own the restricted stock. And it's a nice way if you think that the entity that you have the restricted stock in is going to increase in value and your share price is going to rise. This is a great mechanism to avoid a heck of a lot of taxation in the short term. Does anyone have any questions on the 83B before we jump on?
I think people are absorbing that. There's been no questions about it yet, but maybe people are it's marinating. No. Yeah.
So it's an important concept. The thing to remember about the 83B election is if you get restricted stock, make sure you think about doing the 83B, and you need to think about doing it immediately because you just have 30 days to make that decision. So the first thing that you should do when you get the restricted stock, do a little bit of research on the 83B. If you have a tax professional you're working with or a legal professional that you're working with, run it by them really quickly right after you get the restricted stock. And as Erica said, it's very, very common with founders.
So
okay,
we have a couple of questions. Yeah. So
Great.
James wants to know then, why would anyone not do an 83B?
So I have received restricted stock from a lot of different companies along the years that I didn't necessarily think were going to have wonderful growth, where I didn't think it was worthwhile to purchase the restricted stock. So you still need to make that purchase decision right up front. And if you think that the company doesn't have growth potential, you may not want to have that capital outlay at the beginning. Now, most of the folks that are on this call are probably at a company that they're very dedicated to and that they really believe in. And if you're really dedicated to the company and if you believe in it and if you have the ability, the financial ability to make the purchase, you should.
Okay,
but I'd like to use that disclaimer that Annie had at the beginning.
It's global. Yeah.
About the fact that I'm not an expert in anything.
And David, you know, I think that the only times I've ever seen 83B, you know, result in a loss is when, you know, it's when the value of the stock goes down. As you mentioned, if folks on the call tend to be co-founders and you're starting out, the value of your equity is pretty close to nil right now, so that capital outlay that you would have to make to file 83B is usually pretty small. And if you're founding a company, you believe in it a whole heck of a lot. And so I think, you know, that is small risk is usually worth it for most co-founders. We rarely ever see a co-founder receive restricted stock and not file for 83B.
Yeah, I think most of the time that people don't file for 83B, it's because they're not aware of 83B.
Right.
Yeah.
Okay, we have a specific question about the logistics of filing the 83B from Jeffrey. And again, you know, David, if you don't have the answer to this, we can follow up with Jeffrey separately. But he's asking, is it still true that you must file the 83B within 30 days and then file it attached to your next annual personal federal return? So do you have to file it
Yes.
both? Yes. Okay.
Yes, and that's a great point. So thank you very, very much for that question. That is a wonderful question and very important. So you have 30 days to file the original 83B, but then the tax year that you're in, when you file your tax returns for the year that the 83B occurred in, you also need to attach that to your tax returns. That's a great point. Good question. Thank you.
And then let's just ask one more before we move on here. I'm not sure. Someone in the audience seems to think there was a discrepancy between what David and Annie said. So just to clarify, she thought David said that restricted stock needs to be purchased, and Annie said that restricted stock does not need to be purchased. It's given. So can you just clear up the confusion there?
I think we were talking about it. Sorry, go ahead, David.
No, Annie, you go. You're much more
I think we were talking about it in different contexts. I think David was talking about either third party buying restricted stock or co-founder at the beginning buying restricted stock, whereas I was talking about restricted stock being given in the course of employment to an employee as a part of their compensation in exchange for the work they're doing for the company.
I think that makes sense. And, you know, we have tons more questions going in, but I'm going to let you guys move on. And, you know, we can, so if you've asked a question, great, keep them coming. But we might save some of these till the Q&A at the end. So let's just go on here to NSOs versus ISOs.
Absolutely. So an ISO is an incentive stock option, and an NSO is a non-qualified stock option. The way I always think about these is that an ISO can only be granted to employees, and an NSO can be granted to anyone, including employees, consultants, and directors. The big thing for an NSO is that you have taxation when you vest, and with an ISO, you do not. In general, I believe it is much better to have an ISO because it gives you more flexibility with your tax strategy. Typically, your tax burden is lower, and if you're exercising options, the owner does not have to pay the ordinary income tax on the difference between the exercise price and the fair market value of the shares. So overall, ISOs are better, but NSOs can be used for a greater population of folks. You can use NSOs for non-employees. So we see NSOs used quite a bit when our clients have consultants or board members or other folks that they want to give equity to as part of their compensation or as part of their payment or for their contributions to the company. I think we can move to the next slide.
Great. So we wanted to talk a little bit about structuring equity. You know, especially in the co-founder context, we at Legal Hero hear a lot from co-founders, negotiating how to split the equity, who gets how much percentage, and people overlook structuring equity and the important role that plays far too often. The way you structure equity between co-founders or the way you structure equity when it's given out as compensation to employees really truly affects things, usually far more than the just total amount given out. So, there are a few different ways to structure the equity. We've dedicated this slide to vesting because everyone talks about it. A lot of people don't really understand how it works, so we thought it would be a good thing to go over it. So in short, vesting is basically the process by which you accrue what I keep calling non-forfeitable rights over equity. It means that you then own the option or you own the stock, and it can't be taken away from you. The schedule, which you often hear as sort of a terminology within option agreements or stock agreements, is the total time period over which the equity is to vest. So you'll often hear quarterly over 3 years or monthly over 4 years, and that just means that, for example, monthly it vests at the end of each month over the course of 4 years. So if you have options that vest monthly over 4 years, that means that at the end of every month, 1/48 of the total value of the options is vesting. And then the cliff is the time period that must pass before any of the founders or an employee's stock vests. So if you have a 1-year cliff that's vesting monthly, for those first 12 months, nothing actually vests because you have a 1-year cliff. And then at the end of the year, all 12 months will vest at one time. So, by way of example, you might, as part of an employee's offer letter, offer them 1% of, the company's options, 1% in options, monthly over 4 years with a 1-year cliff. That would basically mean that 0.25%, right, 1/4 of the grant vest at year 1, and then every month thereafter, another 1/48 vest, or 0.02% in this case, until the full 1% has vested over 4 years, at the end of 4 years. So when you're talking about employees, we've seen a market term emerge. You always see folks with 4-year schedule vesting monthly with a 1-year cliff. We see that over and over again. We talked to a lot of VC firms. That's what they're used to. It does seem that has emerged as the sort of dominant market term.
And it's been, Annie, it's been the dominant market term for quite some time. I mean, it's very, very typical, and it has been that way for a long time. 1-year cliff and then vesting monthly after that. But.
Absolutely. And and folks say, what's the big deal about vesting? Well, hey, it protects companies against people from people who leave early. We see this in high-profile news cases with sort of successful startups. There's been a movie about it. Basically, people leave early, and without vesting, they walk away with a massive chunk of the company. You see it a lot with co-founders, and it makes a massive difference. Let's say you've got 2 co-founders who split the company 60-40, and without vesting, 1 month later, that 40% partner walks away. Well, they're walking away with 40% of the company, and it really doesn't lead to a good situation. On the other hand, if that co-founder had been subject to, a 4-year schedule with a 1-year cliff, that seems to be the market term, they would be walking away with 10% of the company, which is ample reward for having, if they're walking out a year later, that would have been ample reward for having stuck around that year. And if they had left within the first year, they wouldn't have received anything at all. So it really is protecting you from your partners walking away. And I think co-founders in particular really struggle with this idea because nobody wants to put restrictions on themselves owning stock. However, if you're working with co-founders, think of it as for the communal good. You really want to reward those co-founders that stay with the company for the long run. And if you are looking to raise venture money, you will often see venture companies, venture firms requiring this as a condition for the co-founders, because the last thing they want to do is put money into a company and then have the people who, are leading that organization leave very quickly after that. So vesting is hugely important, but there are also other structuring considerations that sort of sneak their way into the legal documents, and people don't talk about enough and actually do make a huge difference in terms of who ends up with what percentages of the company at the end of the day. So these are common terms. You'll find them in the in sort of standard stock option plans, as well as option agreements and restricted stock agreements. So just to sort of go through them, when you think about transfer restrictions, they're just terms that determine when stock can be sold or transferred. You'll often see that co-founders aren't allowed to sell the stock to anybody unless, they are able to transfer it to their heirs if they die. But basically, they really strictly limit who can own the company so that co-founders don't end up sharing the company with strangers. Rights of first refusal are found often with both co-founders and employees. This gives the company the right to basically match the price that an employee or a member of the company is selling it to a third party, to a third party, excuse me. And again, that's because you want to control the universe of stockholders out there. Repurchase rights are so important, and they give the company the right to buy back stock. And this is essentially a way to, again, keep that stock close, keep the stock in-house so that it can be used once again to incentivize future employees without, further diluting the current holders. And you'll see this, these terms have become pretty standard within plans. So you'll often see that within restricted stock agreements, companies can buy back stock at whatever the fair market value is for vested stock, unless their person is terminated for cause, which is usually defined in the agreement. And then they can also buy, if the co-founder paid for the stock, they can buy it back at cost for unvested stock. So the idea is to make the co-founder whole. And this is something that is really common. It's, it doesn't mean that the company is definitely going to exercise its right to do so, but companies like to reserve that right. Termination provisions are really important. So when options specifically are granted to employees, they usually have an expiration date of 10 years. So in other words, once options vest, you have 10 years to exercise that option and buy the underlying stock, which is great because you can look around, you can see where the stock price goes, and really time it for your own benefit. That differs a little bit from NSOs to ISOs, I should say, but usually it's about 10 years. What happens when you leave the company, though, is that unvested stock and options are automatically forfeited, which makes sense, right, because you're not meeting the vesting provisions. And then vested options become subject to adjusted expiration dates. So what you'll end up seeing is, depending on the circumstances of the employee's exit, the expiration date adjusts. So if, for example, if the employee just quits, they usually have 30 days to exercise. They usually have about 30 days to exercise any options that have vested. If they're fired for cause, those vested options generally terminate immediately. And if they're fired without cause, then employees usually have about 90 days to exercise their options. So those are sort of standard market terms in option plans that basically define. And of course, if you stay with the company and you're not leaving, then usually you're going to stick with the initial expiration date, which is usually 10 years. And the idea behind that is, again, you know, first of all, it makes your cap table more predictable. You don't worry about all these former employees out there, you know, in the universe, potentially exercising options at any time over the course of 10 years. You also, you know, want to have those options back in the pool if they're not going to be exercised, so that they can be used to incentivize current employees contributing towards future growth. And then the last structuring consideration I'll talk about is something called accelerated vesting. Basically what this does is, you know, regardless of the schedule, regardless of the class, accelerated vesting basically causes vesting to happen upon certain events that you can define in the agreement. So you'll often see this if a company is acquired, it'll result in accelerated vesting, or if an employee is fired without cause, it will result in accelerated vesting. You will hear terms like single trigger acceleration versus double trigger acceleration. Single trigger usually means that just only one thing needs to happen to cause the acceleration. In that case, most commonly, an acquisition of a company by a third party. Double trigger basically means two things have to happen at the same time. For example, the company is acquired and you get fired. And so therefore all of your equity vests at the same time. What we're seeing more and more is that co-founders often still have these provisions within their own restricted stock agreements. It is becoming much less common for employees to have it, other than, you know, down the line, certain key executive employees that negotiate it separately into their compensation package. But for your sort of standard employee that you're hiring and giving some equity to, we're seeing that less and less these days. Many stock option plans usually leave this at the discretion of the company to determine whether or not to actually provide for any sort of acceleration.
Great.
So let's, sorry, David, do you have anything to say, or are we going to move on to 409A valuations and how important they are?
No, Annie, I think that's great. I think that was a great overview. I think that's fantastic. Let's go ahead and move on.
Sure.
So I'm going to go fairly quickly through 409A so that we leave a little bit of time at the end for questions. But 409A valuations became a requirement as part of Sarbanes-Oxley. Sarbanes-Oxley was a federal law that was passed as a result of what happened with Enron. So I'm sure all of you remember when the large utility company Enron went under and there was all sorts of financial irregularities associated with the company. And the federal government put into place a law called Sarbanes-Oxley that was meant to address a lot of the concerns that came out of the Enron fiasco. And one piece of that legislation was a requirement for a 409A valuation. And what a 409A valuation is it's a value on your common stock if you are a privately held company. So if you are giving out stock options or restricted stock, you need to have a 409A valuation that will basically say what that common stock is worth. And this is a federal requirement, and it is an IRS requirement. Almost all of our clients give out stock options to their employees, and so almost all of our clients get 409As. You have to have a 409A done either every 12 months or when there is a significant event. And for the most part, we see significant events being raising of funds. So if a company raises an equity round, they will be required to get a 409A valuation. Now, just a little bit of a plug here, Early Growth Financial Services does 409A valuations. We have a large 409A valuation team, and we provide 409A valuations for our clients and also other folks that are out there in the ecosystem. It's fairly cheap to get a 409A valuation done, but it is absolutely essential And if you have an exit at some point in the future, either through an acquisition or through an IPO, if you have not been careful about your 409As, it can be very costly to you, and it can be very, very problematic. So this is a compliance check the box. It's just like getting your taxes done. You need to do it. It's essential. It's very important. It's a pain in the ass, but make sure you do it. So there's multiple things that go into a 409A valuation report. And on this list, we have a bunch of different things that theoretically would be looked at during a 409A valuation. In reality, when a firm does a 409A valuation, they look at three different things. They look at public market comparables. They look at your discounted cash flows, your fair market value of your firm based on your future cash flows, which is a financial forecasting exercise. And they look at any priced rounds that you have closed. So if you close a round with a venture capitalist or a private equity firm or with angel investors where someone has purchased equity in your company, that purchase price is utilized as a baseline for your 409A valuation. Those tend to be the three major ways that a company's 409A valuation is determined, with the last methodology being the most important. If a company has received money for selling equity, that is almost always utilized as the baseline off of which the 409A valuation is done. Why don't you jump into, Eric, are we done with the 409As? Is there any other section that we need to cover?
Yeah, I mean, I think you pretty much already addressed when you need a 409A valuation, so I don't think you need to go through that. And then the last thing, is basically, I don't think you need to go over this, but I think it's useful for people to look to as reference. If you are going to have a 409A valuation, these are the kinds of things.
Absolutely.
Yeah, so if you want to just say a few words about that.
No, I mean, the thing is, in order to get a 409A valuation done, you're going to need to pull together a bunch of information on your firm and on your company's financials. And this is a great list to just keep in mind, print out this page, set it aside, but have all this information ready to go when you're ready for a 409A.
Great. Yes, I think that pretty much takes us through valuation and to the end here for a Q&A. Before we turn to the audience, Annie or David, do you have final thoughts before we start taking questions? All right, let's just go.
No, I think that's
okay, let's just go. Sure. Okay, let's do it. So we have about 10 minutes and we have some questions here, folks, and you can keep the questions coming in. And again, if we don't get to them, you see the contact information here. So, if it's a 409A question, feel free to follow up with David. If it's, any of the content that Annie talked about, feel free to follow up with her. You see how to get in touch with them. I'm going to try and go through the questions. Some of these are a little bit specific maybe to your company, so I might not get to them in the group here, but I'm going to do my best. And also, Annie and David, a disclaimer to you guys. I'm just a marketing person, not a lawyer and not a tax accountant. So if I am relaying some of these questions to you and they don't make sense in this forum for you to answer, just say that and we'll skip it and we can follow up offline on those, okay? So that said, we have a question first from Lisa about 409A valuations. She's asking if every time you hire someone with options in their package, do you need to do a 409A?
No, the 409A is going to stay for 12 months or until there's a significant event. So, you get your 409A done on July 1st, you hire 10 employees over the next 12 months, you use that 409A valuation. But then next July 1st, you need to get it re-upped.
Okay, great. And then let's see, we have a couple of questions about dilution here. So let me see if I can combine those. Grace wants to know, what are the terms for dilution for stocks issued to early employees?
So So usually, I mean, you know, what usually the way dilution is handled with employees is, you know, employees do get diluted like anybody else. And so I should say the way that options are set up, which is usually in the form of a stock option plan. And what happens is the board will set aside some percentage of the company's equity, so 15, 20% of the company's equity that the executives and the board can then use to give out options to employees representing that 15 or 20%. That tends to be standard. Venture firms will require it when you raise money. Everyone wants to make sure that you've got enough of the company to give out. As you raise additional funds, that that does become diluted, and they will often ask you to sort of re-up the size of that pool. So if you're down to 10% and you raise more money, they'll want to see it go up to 20% again. What you do.
Annie, we should say on that, if you raise additional money and you increase your pool, that increased pool is utilized for new employees that come on board. Mm-hmm. But oftentimes, we also see some of that new pool distributed to the existing employees. So the existing employees, you close a new round, they're all going to get diluted, but there is an opportunity to combat some of that dilution or make that dilution a little less severe by offering or providing additional options.
Yeah, exactly. And and I have to say, not as a lawyer, but as a business, I'm a big advocate of that because especially where you have vesting and cliffs, you want to keep these your employees incentivized over the long term, and that often means giving them grants on a periodic basis, not just on the day they're hired. And so that's to combat partially any dilution. And also just to give them more because they're doing more for your growth. And one thing people forget about dilution, by the way, is you get diluted and so you own a smaller overall percentage of the company, but usually you're getting diluted because your valuation's going up. So that smaller percentage of a bigger pie might represent a bigger number overall.
You know what, Annie? That's a killer point. That's a great point. And a lot of times employees forget that. You have less shares, but your shares are often worth a heck of a lot more. So when you close a round, your net worth has probably gone up as opposed to going down.
Right.
Great. I think you guys actually covered a lot of territory there. I think just to shout out to the crowd, Jeffrey and Paulo, you had related questions, but I think that Annie and David just covered those. But if you have any follow-on questions, let us know. Okay, so let's see. James wants to know, are there any rules of thumb for how much equity should be offered to startup contributors in the beginning? He's saying in particular he has a really big contributor and he wants to reward her, but he doesn't want to give up too much of the company at this early stage.
And so we do have some guidelines on that. It's a little bit qualitative. There's not set rules out there. But depending on the stage and depending on what the person is doing within your organization and how much they are contributing, there are some standards that are out there in the marketplace. I would suggest if you're trying to figure out what your cap table should look like and what those option sizes should look like, if you have a CFO, work with your CFO on it. If you have a lawyer, ask your lawyer. If you don't have someone that can help you with that, then you should think about hiring Annie or hiring us.
Okay, let's see, just looking through these questions here. This one's kind of a specific one from Chris. He's asking, don't most restricted stock come with a restricted stock purchase agreement that spells out the purchase price? Is that true?
Yeah, you're going to see that with co-founders. So, yeah, you're always going to sign some sort of an agreement. And at the very beginning, when the stock is distributed to co-founders, there's a concept in any contract called consideration. You have to give something to get something, right? And so with co-founders, they're contributing to the company in some way. They're giving money. They're giving maybe a piece of code. maybe they own a trademark. You're contributing to the companies in different ways, and what you're putting in the company is getting you the restricted stock agreement. And with co-founders, there's often a price in that. When you're talking about employees being given, it's actually a restricted stock award that you'll see, and the consideration is the actual work that you're putting into the company.
Great.
Does that clear it up?
Yeah, I think so. Okay, let's see. Sorry, I'm trying to kind of read and ask at the same time. So let's see.
I'm happy,
yeah.
Erica, that's a situation, by the way, where I'm happy to take a question. If there's a specific question behind that, please do email me. Sounds like there might be a specific question behind that. I'm happy to talk about it one-on-one.
Yeah, sure. So that, Annie's email's right there. If anyone wants to reach out to her with specific questions, please feel free to do so. Let's see. I'm trying to see. Paulo is asking. I'm going to read this out loud, and then maybe you can help me parse this. How much equity should be given out or set aside for a major contributor to the company? Considering that the main founder holds 65% of the company, one holds 30%, and another 5%. Maybe that's too specific. Can you?
Yeah, you know what, Erica?
Yeah.
Why don't you just send me an email?
Yep.
Send him an email. Yeah,
okay.
We'll take it offline.
Okay. Sorry, I'm trying to figure out. Let's see. Let me see if I have any more general ones here. Just to repeat yourself, Lisa's asking for clarification. She said, "Is there a typical size to make up an option pool when you set it up?" She thought you mentioned 20%. Is that typical?
Yeah, you often see 15 to 20%, and that.
And Annie, when I heard that question, that was the exact same thing I thought in my mind, 15 to 20. Mm-hmm. So you're right on. Yeah. Sorry. I keep interrupting you, Annie.
David mentioned there. No. What I was going to say is, it's funny. As David mentioned, it's really hard to get market terms for specific types of employees and what to give them. But it's really nice when we can rely on market terms for some numbers, like that 15 to 20.
It's nice to have an answer at the ready for some of these. So.
Yeah, exactly.
There's some things that are so typical that it's very easy to speak to.
Right.
A special employee who's contributing a lot, what they get, that's a little bit
really variable. Yeah. And it depends on, there's many factors that go into it. So I think I think we've done our fair duty here in getting through most of these questions. You all know if you have an outstanding question, so there's contact information here. I'm going to leave it to you.
Great question.
Really good question.
Yeah, great
question.
I was going to comment on that. You can tell what are the hot button topics by how fast and furious the questions come in, and I can't think of a more engaged audience that we've had at a recent webinar than this one. So thank you all so much for attending and for listening with such rapt attention and for jumping in there. So we appreciate that. Just a quick plug, for us, we have our next webinar on July 8th with Mary Jutin from TrackWhite, and this is on another hot button topic I know we have questions about all the time, crowdfunding. Specifically, we're going to be focusing on how to practice safe crowdfunding and give you some tips for successful campaigns. So if this sounds like maybe of interest to you, please check out our events page to sign up for this, or you can also see the other upcoming webinars we have. We have a full schedule for July and some really good stuff, so we hope that you will join us. And with that, please feel free to follow up with us on outstanding questions. We'll be getting the deck and the recording tomorrow. And thank you, Annie and David, so much for your time. This was really helpful. Thank you.
Fantastic.
Thank you.
Thank you.